And month over month, from January to February, we typically see a negative 0.16% decrease in listings for sale. If you look at the average going back to 2017, we saw a 10% increase. That is significant. And so, what that tells me is there are a lot of motivated sellers out there. They're not even waiting for rates, they need to get those listings out there. And then what's going to happen is the sellers, like the one I was just telling you about, they have to make a decision. So they are slashing. And the institutionals, by the way, they're doing it quietly in certain cities like San Antonio and Florida and Atlanta. They have started selling at deep discounts as well, their long-term rentals.
Hello everyone and welcome to another edition of CEO and Market Expert Interviews. I'm your host Lucian, most of you know me as Triangle Investor from social media. I'm joined today by Melody Wright. Melody is the CEO and founder of Haringa, a mortgage strategy and technology company. She is a housing market expert and much more. Melody, I'm very glad to have you in my show. Thank you for coming.
Thank you so much for having me. It's my pleasure.
Thank you. The pleasure is all mine, by the way. Melody, let's kick off with the big question, and that is
Okay.
how strong or how weak is the housing market today in the United States?
Well, so historically speaking, it is abysmal. We haven't, if you look at just the existing home sales, think about it as used homes. We haven't had sales like this since the 90s. And so if you look at the new home side, they're doing a little bit better, but combined sales, we haven't seen numbers this bad since 2008 to 2011. And we have grown the population by 70 million. So we're talking about absolute levels, not adjusted for population. So I was just actually looking at an article on China this morning, and they as well are talking about how, the worst housing market they've had in almost, 15 years. So we are definitely in the United States. It is a very tepid market. What's happened is, there's plenty of people I think who want to buy, but they've been priced out of the market, and the sellers have remained stubborn. And 2024, there was a lot of hopium, is what I call it,
Yeah.
and rate cut hopium as well as election hopium. And we those were everybody was expecting with that September rate cuts that mortgage rates would come down. Obviously, they did not. The 10-year Treasury, which is what mortgage rates really follow, had some different ideas. And so I think you're starting to see that hope dissipate. And what we had was a very unseasonally strong October here in the United States. And then it kind of slowed back down in November. And then it accelerated again in December, even though rates weren't down. And what that told me, and I track 80 plus markets every single week. I look at what they've got listed. And what it told me is that there are people that they have to do something this year. Like they put everything on pause last year, but because of death, divorce, default, they are going, and I'm seeing this in my client books. I oversee mortgage clients as well. People who are in distress, they've used all of their workouts because here in the United States, we assist our mortgage borrowers heavily. In fact, during COVID, we did unprecedented intervention to kind of shore up that mortgage market. But what's happened is you can see it. They've used their workouts or they don't qualify. And now I see these comments. Well, I'm trying to sell my house. And a good example I just saw that sold yesterday had been sitting since September. And how did they sell it? They did it with price cuts. And so that's a long-winded answer of saying we had abysmal sales in 23 and 24, so low. And they really reflected one another. If you look at them, very similar years, despite all of the nonsense you heard in the
Yeah.
media about it. But I think we're actually going to see a little bit stronger sales this year. Nothing huge, not like 21 or 22, but just slightly stronger because people have got to make decisions. They've run out of time.
That's a great overview. So, a lot of red flags, if I dare to say. I don't want to sound gloom and doom, but do you foresee a housing market correction or a crash or even mother of all crashes? How do you see it going forward?
Yeah, so I see a correction. Is there some possibility of a crash? Well, look at how quickly home prices went up. And what so many analysts are missing, like it is just, it's actually kind of weird. They just are missing the level of speculation that started. It started back in 2000, like late 90s, and it just kept increasing. And there was a little hand slap, during the great financial crisis, but then Wall Street got involved. And once Wall Street got involved, then the speculation went wild. And then you had everybody watching those fix and flip shows on HGTV or whatever, and they looked at this and they said, I'm not making it on my regular job. I have to get that passive income. And so your doctors, lawyers, your shoe shine boys, that's a
Yeah.
reference to, yeah, they were buying homes, our multifamily buildings, are getting into the speculation game. And so I think a lot of people are actually missing that component. And so there is some likelihood there could be an actual crash, which would be a sudden drop in home prices. But right now, I'm seeing more of a correction. But things are happening very quickly right now in the United States.
Yeah.
Things are changing. And so this year, I'm calling for a 9% kind of year over year drop in the National Association of Realtors series and a 6% drop in the new home series. Now, that actually may be conservative. I'm seeing early surveys from the builders that this is one of the worst Januaries they've ever seen. And typically, this is when they start cranking the engine for new home sales. They kind of live off the scraps at the table of the used home market. That was very different last year. They kind of drove the market. But typically, you see them when the used home market is kind of slow. They actually accelerate, and that's not happening. And
Yeah.
so the only way they're going to be able to move the product is through cutting prices.
Yeah, agreed on that. Melody, which segments of the real estate market could take the biggest hit, the biggest beating? Commercial, something else? What do you think?
Well, I think commercial will be first. And so people want to see commercial and residential are inextricably linked. And it's so odd to me that most of those commercial buildings were built and then the residential followed. Or what happened in this last cycle, and it's probably happened many times before, is the promise of the projects
Hmm.
brought on all of this building. I mean, what I saw out there on the road was insanity. Multifamily, you could see Evergrande towers outside of Nashville that were completely empty. But so many people don't get in their cars and drive around and look what's happening. They just go online. So, to answer your question, I think commercial is first, but residential is close behind.
Okay, like you said, you were out on the road, you were among the people, sellers, buyers, investors, builders. How is the current sentiment among the buyers and how is the sentiment among the sellers? You answered the portion of it, but is there any room for panic?
It's starting. And I honestly think, and so, what you can see, and I think this is kind of comical, but not. It's kind of sad. You could see after the fires in Los Angeles that all over California and quite frankly across the country, all of a sudden listings came back onto the market, listings for sale. In the US during the holiday season, you typically see a real pullback. During the winter months, nobody wants to think about, buying, selling a home because it's cold,
Yeah.
Down in Florida, you do because you've got the snowbirds in Arizona, et cetera. Um, but what you saw is after the fires, when everybody thought, oh, 12,000 structures, single family structures destroyed, they're going to come to Nashville. They're going to come here. And so all of a sudden, month over month from January to February, we typically see a negative 0.16% decrease in listings for sale. If you look at the average going back to 2017, we saw a 10% increase. That is significant. And so, what that tells me is there are a lot of motivated sellers out there. They're not even waiting for rates. They need to get those listings out there. And then what's going to happen is the sellers, like the one I was just telling you about, they have to make a decision. So they are slashing. And the institutionals, by the way, they're doing it quietly in certain cities like San Antonio and Florida and Atlanta. They have started selling at deep discounts as well, their long term rentals, because no institutional is going to look at this and say, okay, my insurance is X, my property taxes, because I don't get an exemption, are Y, my maintenance costs have gone through the roof. Like, no, thank you. This just doesn't even make sense anymore to an institutional investor.
Yeah. Mortgage delinquencies are rising despite low unemployment. How do you see that in 2025?
That's just, you know, it's kind of crazy to me. What people don't realize is we had intervention during COVID much bigger than we did in the GFC. So, of course, delinquencies are very low. And there's a lot of trouble with the different series out there that track them. For instance, the Fred only tracks commercial banks. Then you have a industry insider, Black Knight, that tracks what's on their platform, which they say is the majority. But I'm really thinking about challenging that statement, like officially, because they have 35 million on their platform approximately. There's over 80 million mortgages. But my point is they're showing lower delinquency. But then the census put out it's a newer series called the Census Pulse Survey, and they were showing a lot more delinquency than any of the other series. So it's increasing, and I see it in my client books as well. And actually, even that industry provider, Black Knight, just said that foreclosure starts increase month over month in December, 50% year over year, not 29%. Now they were like at the bottom, they were so low. So those increases are going to look rather large. But what you're actually seeing is delinquency is starting to get really sticky. It started in FHA, which is more of your first time home buyers, but now it's kind of spreading out into the prime. And so we are now entering the default cycle officially. And most people are just saying it's normalizing, but with these rates of change, that's not what's happening. The consumer is tapped out.
Yeah. Do you see any parallels with the real estate crash in 2008? I know it's a little bit different in some way today. Today's financial system has more safeguards against such a crisis, but growing complexity, like you said at the beginning of this interview, in the financial markets, the rise of dividends based on cryptocurrencies and shadow banking could create much more new risks, right?
Yeah, and I would argue those old risks are still there. Unfortunately, Dodd-Frank was neutered when they took out the debt to income uh, cap. And so, this is complicated and sorry, but the GSCs are Fannie and Freddie. They never actually had to abide by Dodd-Frank. They had what was called a patch. And so the idea that lending was somehow, there was better credit quality. And for the longest time, I believed that as well because I was in the industry. I left around 2021, but now what I'm seeing in client books, what was originated, it's just the government stepped in and they did government-backed subprime, and borrowers with credit scores as low as 580, sometimes even lower. And we know credit scores were inflated, and so and so Ginnie Mae, which is FHA and the Veterans Program, they're 22% of the market and they're at 9% delinquency. That should make people stand, because that is very similar to what we saw last time with the subprime being about that same percentage of the market. And people misunderstand what happened back then. Yes, subprime started it, and we had a liquidity and collateral crisis here in the United States, meaning, the con was up and the money game was up, and there was a money shortage. It wasn't subprime mortgages because they weren't that big. I mean, that's not what took it. It's the derivatives, it's the collateral, it's everything underneath. And now, like you say, that market's even bigger. And so, I think that there are many similarities, but I think it would be, people need to understand what happened back then to understand that really the government just took the place of subprime. And so, and the prime borrowers are what really where the foreclosure crisis happened last time was in the prime borrowers. And we're starting to see them get impacted.
Yeah, I believe that you get a lot of questions from the people from the street asking you about the red flags, incoming red flags. So what do you say to them? What are the biggest red flags that people should pay attention to at the moment? We covered some, but can you sum it up?
Affordability is really the big. So affordability and demographics, and the speculation. So I think those are the three biggest. But affordability, just go take historical median household median income. Go take, you can use the NARS series, National Association of Realtors, and look at household our median home prices. We have never been so far off the mark. We simply cannot afford these homes, and the top 20% cannot carry the entire housing market. And you can see them pulling back. They themselves don't need five homes. And they, of course, were part of these speculators who are thinking, I'm not making cash on this. Why am I going to carry this albatross around my neck? That doesn't even make sense, And so you've got demographics. And so Harvard just, every January they put out their, kind of household formation study. And they said that between 2025 and 2035, 15.6 million boomers are going to leave us. They will not need housing. Between 2035 and 2045, 23 million are going to. And so when you start looking at these numbers, and it's wild to me, over the holidays, I got a bunch of calls from people who need help with a situation where a parent has died or they're about to die and they've got a property that the kids don't want it and they want to sell it and get the money, or they want to retire into it and give up the home they're living in. And so this is called consolidation. And so for everybody that's been out there talking about an inventory shortage, that is simply not true. It's not borne out in the numbers. You can look at the Cato Institute, or Taylor and Francis did some recent articles on that. We have plenty of housing. It's just misallocated. A lot of that is a speculation. 12,000 Airbnbs in San Diego, 15,000 in Austin. Nobody needs that many. And so 15 million vacant properties here in the United States already, similar to Japan, And so the idea of a shortage makes no sense with our current demographics. So to me, those three things: affordability, demographics, and speculation, those are the big red, and all the fraud. You're seeing fraud everywhere, which is part of that speculation.
Yeah, I would add one, if I may, maybe the
Sure.
future of home ownership costs.
Yes. Insurance, tax, and that really goes to the affordability, right? It's that insurance has gone through the roof. State Farm just came out in California and said we're going to have to raise it by 22% just to deal with this storm. Property taxes have gone through the roof because they're based on that property value. Maintenance costs, like you say, gone through the roof. And so affordability, there just is no affordability in the market anymore. Not even for investors, which is everybody's favorite. Well, the investors are going to come save it. Why would they do that right now? The only way they come back in is if prices did crash, not
Yeah.
even correct. Yeah.
Yeah. Melody, how is the situation in other parts of the world? We covered the United States. The ones that you are following closely. How is the situation there?
Well, I wish I could follow more, to be honest. The Bank of International Settlements does a wonderful quarterly series where the housing markets in all these countries is something they focus on. But of course, they don't summarize it for you, and you have to do all this. And so I just don't have time to follow a ton, but I follow China very closely because I feel like they're a mirror to us and we're a mirror to them in many ways. Because if you can look at, and I was mentioning that Bloomberg article this morning, they're trying everything they possibly can. They overbuilt, they really didn't want to stimulate, so that they're trying to revive the housing market. And I think there's a lot of parallels, and it's kind of funny. In some ways we're behind them, in some ways we're ahead of them, because they kind of have this 2008 plus what's going on now combo situation in China. But as we were talking before the show about your own market,
Yeah.
and we see that all over the world. Canada. I mean, I wish I had more time to focus on Canada because that just sounds like insanity up there. But but generally China is who I follow the closest.
That's great. Maybe final question. I want to return to the prices. What are you seeing and hearing about wanted prices, the gap, the spread between the wanted prices and the prices actually achieved? How is that going in the
It,
United States? Of course, probably it depends on the state, on the city, on the property, but how is that going?
so it's the gap is so wide. And so you're right, of course, it varies by city, but in aggregate, you're looking at somewhere around a median home price right now with used homes around $404,000, and in reality the median price that America can afford is about 315K, and that's stretching it. It's probably less than 300K. So the gap is massive.
It's massive. I thought so. Maybe final question. Do you see governments imposing new taxes on real estate in any shape or form?
I think all bets are off. Like they could, because I think what we're seeing right now, and sorry, things are happening so fast, so I'm still formulating my thoughts on it. But we're actually what we may be seeing. It's not totally obvious yet, but we may be seeing financial repression to the point of really taking some of that wealth from those that can afford it, kind of capturing it to even things out. And so, they could use taxes to do that. I mean, the idea, and maybe this is just politics, and I don't know, but the idea that they're attacking that carried interest. I mean, this tells me this administration, if they go through with that, is willing to take some risks to like fix what, and of course there'll be unintended consequences from anything they do, but they could very well use taxes and make it, I mean, quickly they could, like on foreign buyers, for instance, federally you could make that overly burdensome, to hold vacant properties here in the United States. There's so many things that they could do. And for the longest time I didn't think anyone was going to have the political will to do anything, but it's looking like there is some will here. How far they get, I mean, we don't know.
Yeah, we will see. That was Melody Wright. Melody, I want to thank you for coming to a show. Great chat as I really expected. And I hope since this is your first time in my show, we will repeat this soon. Thank you very much.
Absolutely. Absolutely. My pleasure.